All right, you guys. Well, good to see everybody on here on this Tuesday. And gosh, there's a lot going on right now, certainly in the world and in the market. And every couple of years, I feel like I do some version of what I'm going to do the next 5 minutes, which is just kind of a reminder of a couple big things anytime we go into these market meltdowns. I mean, I wouldn't call this a market meltdown. This is a market correction, but they're always unsettling. I just got off the phone. I had one client email me last night that just kind of wanted a little reassurance. He wasn't panicked or anything, but he's retiring this year. And so I just got off the phone with him for 15, about 15 minutes ago. And I told him a couple things that I'm gonna get into a couple things for you guys that including one statistic I think is really fascinating that I didn't get into with him. But there's always a label for a market correction. Anytime we have a market correction, there's always going to be something you can point to that, says, well, it's because of, Putin, or it's because of Trump and tariffs. And then we start inventing all these phrases that the media likes to talk about. And you hear things like growth scare. And before too long, you're going to start hearing people coming out of the woods and talking about, well, we have a recession coming, and that's kind of ridiculous because I can't imagine we have a recession coming with as strong as employment is and as strong as our economy is right now. But I want to tell you guys a couple of things. Just maybe you can use this for your own knowledge or for any talking points with clients, and then it'll feed into what we do with FMAX here. But I would tell you, number one, this has been by far, so this is my 25th year. This is absolutely the most hated bull market in probably modern history. And what I mean by that is the amount of mutual funds, professional investors, registered investment advisors, talking heads on TV, economists that have been so wrong for the last 2 to 3 years that have been constantly talking about stocks can't go higher. This is out of control. This AI is overdone, all of that. They have missed one of the biggest bull run-ups in modern history. And so they've been wrong for, let's call it, 80 or 90% of growth. And now they're right for 10% of growth. And they're going to come out of their caves and declare victory. And that's the cycle we always go through. And so we are due for a correction. We're way overdue. Last year was one of the most combination low volatile, strong kind of market years we've really had in recent memory. But corrections clear leverage and they clear over exuberance, over excitement out of the market. And that's really healthy for long-term bull markets. It just is. And so, they're always painful, they're always unsettling. I don't know anybody that enjoys market corrections. I don't enjoy them, but I recognize them for what they are. But it reminds you of a couple things. Number one, us, if you're an investor, which all of you are, all of our clients, we own shares of growing companies. And it just so happens that the valuation of those shares is being quoted every second of the day. In fact, most of the markets are in exchanges are moving to 24-hour trading in the next 2 years. And so, just like crypto trades 24/7, you're going to see that in a stock environment. Very in the very near future. And so there's no way. Just take Tesla, that there's no way Tesla is worth twice as much 3 or 4 weeks ago as it is today, or inversely, it's worth half as much as it was 3 weeks ago. I mean, that's just crazy. Now, probably got a little too high, probably a little too low right now. The market will settle that out somewhere in between, but there's a ton of stocks like that, you guys. So don't be distracted by the speculation. Of course, the media is going to assign always things, and they have to have something to talk about all the time. But I was talking to my mother-in-law over the weekend, and she's retired just this year. Actually, December 31st, she retired, and she's a warrior by nature. God bless her. And so, she looked at me and she's like, I just hope we don't go into a recession right when we retire, right when we need the money the most, all this stuff, right? And she's like, I bet all your clients are calling you, like that whole cycle of conversation. And I just, reminded her of a couple things, but I said, the two areas I've added the most value to my clients over a long period of time are, number one, I've I've gotten them to save more money than they otherwise would have saved with me because we sat down, we had a conversation about let's redirect more money, let's increase it. Hey, can we do a little bit more this year? Like all those, the cumulative effect of all those conversations have helped my clients as a whole accumulate a lot more wealth than they otherwise would have had. And the second thing is I've had them more allocated towards stocks than they otherwise would be on their own. And so the massive amount of outperformance that we've achieved over many, many years in some cases has helped a lot of my clients become incredibly wealthy. And I'm not, that's not me taking credit for all that. I'm just saying I'm not a market timer. You're not a market timer. I'm not managing portfolios. Although we're going to talk about that a bit with FMAX, how we can kind of delve into that a little. But my job is not to beat the market or avoid all these losses. It's not to be tactical. It's to turn, people into long-term investors that ultimately will help them become totally financially independent. And what a career we get to do helping people do that. And so I want to leave you guys with one last stat, and then we're gonna shift into FMAX just to give you guys some comfort. So I saw this yesterday on a podcast. Since 1928, we've ended the year down 10% or more in the S&P 500 12 times. So right there, if I were to ask most of my clients, most people out there in the retail world, how many times since 1928, so we're right at 100 years just about, do you think the market's average or has lost more than 10% at year end? And I'm willing to bet that far people would be shocked by the number 12. I bet people would answer, I don't know, 20, 25 times. Like they probably answer a higher number. That's my opinion. But here's what's really fascinating. Eight of those were due to a recession. Now we've evolved the definition of recessions a bit over years, but a deep economic decline. And I could spout off all those, a couple in the 30s, couple, 57, 73. But the most recent two are 2001 and 2008. Three were due to global war, so World War II, 1940 and 41, and 2002 when kind of the whole Iraq and Desert Storm and all that stuff was going on. And one time, which was only a couple years ago in 2022, was when everybody expected a recession because the Fed was raising rates so much. Call it a shock, a raising rates 75 basis points at a time. And even that didn't throw us into a recession, believe it or not. But that caused enough panic in the market and enough resettling of prices. And so I want you guys to think about this. We are nowhere near a global war. In fact, if anything, we're probably backing down away from global war right now. It would be you'd have a real hard time competently projecting that we're on a path towards a recession, without going down that tangent. There's just factors that need to be in place that just aren't even on the horizon as far as the eye can see for us to go into a recession. And so this is a garden variety market correction. I consider it a massive buying opportunity. I mean, I'm probably down north of $300,000 in my own accounts right now. And you can't imagine how much that doesn't affect me because I don't have a single penny invested that I'm gonna touch for as far as the eye can see. I need for anything in my life, I just don't invest like that, right? That's the purpose. And I would argue we do the same thing with our clients. I don't have any clients in 90% equity portfolios that couldn't stand a swing like this in their market. That's why we have a whole spectrum of fixed annuities all the way to growth funds and all this stuff and a whole bunch of stuff in between. You guys, that's our job. So anytime as a quick tangent, anytime you read an article or come into contact with somebody that thinks that, well, why do you need an advisor or what's the value there? Is an advisor worth their fees? I think we're worth three or four times our fee in terms of the value, the relationship, the talking through, the design, the planning that we do, the service work that we do, all of those kinds of things. And so, anyways, I really feel strongly about the role we serve, and I think what we're going to get into here with FMAX is going to be take that to a whole new level. So let's jump into that, you guys. I'm going to share my screen, and let's see here. Hopefully, I'll do this in a way that, okay. Sorry, you guys seeing my WFG on your screen right now? All right, so A lot of you probably know how to get in here that are Series 65 licenses, but you just go to, I just have it saved in my little toolbox up here, but I go to TFA Sales Tools. That brings me to this page right here. And then I click this Wellscape button, and that's going to take me to a page that looks just like this. I have it loaded just for sake of time here. And so this is going to bring you to Wealthscape. And so I'm going to tell you right off the bat, here's my disclaimer. I am not an expert in Wealthscape and FMAX. I'm a little farther down the road in it than most. But this is the kind of thing that takes a little time to get involved in. But before we jump in, let me give you guys a little bit of background. And so I'm going to stumble through a couple things, but I'm gonna show you guys a lot as we get through this hour. But the first thing that I do is the reference point that many of us have is Goldman Sachs. And so we start looking at FMAX compared to Goldman Sachs, I mean that was my reference point, and it's just a very different platform. We're talking about an apple and an orange. There's some overlap, there's some similarities in that they're both advisory platforms. But to give you guys a backstory of how we got here, that's I think worthwhile is the reason we set up the platform, and this is before I was involved in any kind of decision-making committees or anything, but the reason Goldman Sachs, which at one time was a private company called Folio Institutional, was chosen, is we were looking for an advisory platform for our market, which is middle and upper middle America. And so Folio really pioneered this technology called fractional share trading, and where you could buy fractions of stocks instead of all that. And so the result of that is it allowed us to get account minimums down much lower than the industry. So even today, when you look at the industry, and some of you that are experienced might run into this, I can't tell you how many times I've reviewed, accounts from other companies, and maybe there's like a, let's call it a three or $400,000 IRA account that's clearly managed in some sort of advisory, structure. But then there's like a $60,000 account, maybe it's a Roth account that is on the same statement, but it's clearly managed differently. It's usually in mutual funds. And it's because even today, the industry has a lot of high minimums, and a lot of these platforms have a lot of entry points that are just tough to work with small accounts. And so the beauty of Goldman Sachs, as a placeholder, Goldman Sachs is going to be around on our platform for years and years to come. It's not going anywhere. Now, the day will come at some point where they turn off the ability to open up new accounts. But they recognize that we're going to have clients on that platform for years and years for a whole host of reasons. I love Goldman Sachs because you can take a pretty small account and blend four or five different strategies together if that's what you feel you need to do, and have as little as $5,000 in every strategy, which is, we take that for granted. I'm telling you guys, the more I've gotten into all this industry stuff the last 2 years, that is unprecedented. So that's the big advantage of Goldman Sachs. However, I wasn't really aware of all the disadvantages of it, and there are many. But a couple of the biggies is it's not really a platform. It's kind of like outsourcing a little aspect of our business if you want to set up advisory accounts, but it doesn't really integrate with anything else we're doing. There's no path to make it happen. There's no app your client can have on a phone. It's kind of this segmented, siloed kind of standalone product. And the direction that TFA is wanting to go, which I fully endorse, is to really modernize us and have us have more of a platform experience where, you know, the day will come where you're going to open up one dashboard, kind of much like this, and you're going to be able to manage your whole business from one kind of platform, regardless of what kind of account it is, including annuities, potentially variable life insurance, all sorts of things. And so there are many iterations of building out this platform that we're going to get into. And one thing I've learned about Wealthscape and FMAX is it is incredibly robust. And so they allow every firm to sort of customize how they want that, kind of experience to be for their advisors. And so there's a lot of levers that TFA can kind of pull, turn on, turn off, adjust. And a lot of that's what's happened. And so I will tell you, I was on a committee like, I don't know, 2 or 3 years ago when FMAX was first getting going. And what we kind of tentatively launched 2 years ago was what I would call not entry level, but just kind of more of a boilerplate industry standard version of this. I'd say off the shelf would be a better description of FMAX. We didn't have the people in place at TFA that we now do that know this system, that have decades of experience in the industry, to kind of lift the hood up and really tool it for our firm. And so combination of the right people that we've hired, which I couldn't have more confidence in, and also some serious funding from Aegon that we've gotten to invest in, all sorts of things. And lastly, negotiating heavily with Fidelity, we've been able to basically retool this to be pretty darn close to Goldman. This will do just about everything that I like about Goldman, and a whole lot of things that I never even knew I wanted until I knew they were out there. I'm like, yeah, I want that. And so we're going to touch on some of those things today. So right off the top, here we are, and this is what I'm going to show you is live. All of you that are 65 licensed have access to what I'm going to show you right now. There's one more update coming in probably 6 to 8 weeks that I'm going to touch on when we get into proposals. And then I mean, we're going to be tweaking this thing and adding things for years. But I mean, this thing is ready for prime time right now. So what is Wealthscape and what is FMAX? Well, Wealthscape is kind of the mothership. That's the whole platform, if you will. And I probably mistakenly interchangeably use those words sometimes, which could cause confusion. Wealthscape is basically the securities platform. So think mutual funds, think variable annuities. Primarily, those are going to be the two things we do initially. Brokerage accounts. So if you look at other firms where maybe they have a brokerage statement, but it's got various different mutual funds in it, Wellscape's going to essentially create that kind of an experience for you. And we're not going to really get into that today. But there's a lot of legs coming to that. The company spent most of their time on the FMAX side of the equation here initially, and then they're going to do more with Wellscape in time. So when you first log in, you're going to log into Wellscape. And you can see some things in both dashboards, but the first thing you guys are going to want to get comfortable with is if you go up here to menu, and just as an idea, just as an example, you could spend a lot of time in here and just get in here and click all of this different stuff. And so when I talk about this as a full business management platform, you're going to start discovering that as you go in, like the amount of visibility, reports you can run, research you can do, the amount of information at your disposal is pretty immense here. So what you want to go do is you want to go to menu, and then you want to drop down here to this FMAX desktop, and that's going to pop you over into, click continue. That's going to pop you over into FMAX. And now we're in solely an FMAX environment, okay? And so this is where you're going to run research, run proposals, create accounts, do all that kind of stuff, which we're going to start getting into here today. So,
Hey
um,
Tyson,
yeah,
did you want to record this?
I am recording it, buddy.
Okay, yep, you sure are.
Yeah, boom. We are live. We're going to do it live. All right. All right. So now that everybody seeing my FMAX dashboard? Did I do that correctly? Okay. So I'm going to direct you to a couple of things, and I'm going to tell you right off the top, because there's a whole bunch of stuff I just haven't gotten to yet. And I'm just kind of doing it as I have time. I get in here, I work on some stuff. So I'm going to lead you right up here to the top. So you got practice, manage, research, and platform. Okay. The three biggies you're going to be focused on are going to be practice, manage, and research. Platform doesn't have a whole lot to it, at least that I can see so far. And so what I want to do is there's kind of a couple different themes I want to take you guys through, and I think in a logical order. So the first thing I want to show you guys here in a moment is how do you research all the investments that are on FMAX? Okay, what's on, what's not on, how do you sort through them, how do you figure it out? And then we're going to get into, kind of putting a proposal together. So once you kind of have done your research and figured out, I like this fund and this fund and that fund and all that, well, then you can start populating them into proposal. And then kind of the whole mentality here is if you want to create an account, so you got a guy that's got an account ready to go. So what you're going to do is you're going to go and create a proposal, and that proposal is going to essentially become, the lead into opening up that account. It would be much like a life insurance IUL or VUL illustration kind of becomes part of that account opening process. And so it's a little different mentality, to give you an example on what we don't have and never would with Goldman Sachs because they're kind of a siloed solution. I just didn't know all this about the industry, but all Goldman Sachs is doing is managing money. That's it. Okay. They're really not built for firms like us. They're really built for fee only registered investment advisors that don't do any securities, any insurance. All they do is manage money. And so Goldman Sachs is kind of like one entity, but you got to have a lot of other things. So for instance, Goldman Sachs doesn't have proposals. And you guys have gotten kind of used to that. I mean, by the way, the people we've hired, they are shocked that we have built as much AUM as a company as we have without a proposal system. Because like you have nothing to show your client of like, here's a proposal, here's all the fees, here's the portfolio, here's what it looks like. And you're going to see that we have that here because all of these different tools are integrated here that I think is easy to take for granted. So let's start with research. So I want to show you guys what's on the platform. So if you click research and you pop down here to all solutions, you're going to see a couple of things here. So I would ignore this legacy sleeve. That was kind of, I hope they get rid of that at some point, although they told me maybe it never goes away. I don't know. That's above my pay grade. The three big things you want to focus on are these separately managed accounts, strategist, and UMA. Okay, so we're going to go through kind of what are the differences here and what all those mean. So let's talk about separately managed accounts. What we have, and I'm gonna use Goldman Sachs as a reference point. Goldman Sachs as a platform is what's called a unified managed account. Okay, and that's an industry term, which essentially means you have one account and you can put any kind of investment in there. You can put shares of a mutual fund. You can put a certain strategist in there. You could buy an individual stock. If we turned all those features on and you were properly licensed, in theory, you could put anything you want in your own portfolio. Okay. So it's very flexible, and that's what we have with FMAX. That's what you want to have, and that's what we've been fighting for massively. The problem the industry has is UMA accounts are more expensive to run. I mean, you've got more technology, there's more behind the scenes, and you run into minimums where most firms, if you want a UMA, you have to have somewhere between 100 and $200,000 in an account to have a UMA. That's why when you look at Edward Jones or I don't know, a bunch of companies, you might see the larger accounts managed in an advisory strategy and the $60,000 account in a few different mutual funds. It's because they have to have 100, 150, 200 to have a UMA. When we launched FMAX, you had to have 150,000 to have a UMA. And so I was probably, I don't know, a month or two into like some committee meetings and stuff on this. And when they first told us that, I'm like, guys, that's a non-starter. Like we cannot go from Goldman Sachs with a $25,000 minimum, which is flexible. Obviously we can get accounts smaller than that, which is a UMA to all of a sudden we need 150. That doesn't fit our model. That doesn't fit most of my clients or many of them. Even my larger clients have smaller accounts, spouse accounts, Roth accounts, whatever it is. And so that just was a massive sticking point. It's one of the reasons this thing never got off the ground last year. So one of the things that we've done is we've lowered the UMA minimum all the way down to, believe it or not, $10,000, which is incredible. They couldn't get it to zero, but $10,000 is pretty darn low. And so they've opened this up a lot. So what I want to start with is in Goldman, when you run kind of that report of all the different strategies on Goldman, what you have is you have fund strategists and SMAs all blended together. It's all in one big list. Here we have it separated. So I'm going to do a couple of things here. So up on the top right, you want to kind of adjust some filters. So right now, if I ran some reports, I'm only going to see 50. So the first thing I'm going to do is go here and click 500. So right now there's currently 216 strategists. They're about to load on a whole lot more, which I'm going to touch on in a moment. However, if we look on here, the other thing I'm going to do before I run any reports is if you look up here, I'm gonna run all product sets. It's as of February 2025. If I leave this at February 2025, I'm gonna miss a lot of these because some of these things report quarterly, some report monthly, so on and so forth. So the best advice I've been given is to get rid of this. Hold on, let me do it. Get rid of this February and go back to the most recent quarter. So if you go, this is just where you got to play around and spend some time. So if you go to this filter button and you go down here as of date, I'm going to go Q4 2024. And then I got to move all your beautiful faces here. Click apply. So now you see Q4. So now if I run separately managed accounts, let's start with that. It's going to pull up all the different separately managed accounts that is on this platform. Now, what is a separately managed account? Think of a separately managed account as a single theme strategy. So if you look at all the names on these things, you're going to see like just focuses on large cap growth, just focuses on municipal income, just focuses on dividend. So most of these you're going to just kind of know by the name, kind of what they do. So think of on Goldman Sachs, you got Congress Large Cap Growth. That's an SMA. Okay. Conning High Dividend Equity. That's an SMA. And so what you're going to see here is on this platform, many of these SMAs have pretty high minimums, 50,000, 100,000. That's one thing. In fact, we've loaded Congress on here, some of their strategies. That's one thing that isn't going to change. We've negotiated some things with Fidelity, but these SMAs all set their own kind of minimums. Okay. And so that's immovable. And I'm going to give you guys a precursor. I'm going to tell you that outside of a very few clients, I'm not going to really use hardly any SMAs, largely because of these fund minimums, but also because of fees. But just to give you an idea, so for instance, you want to check out, okay, BlackRock large cap value. I'm just picking this one randomly. You click on anything, and I love how user-friendly all this is. So you can get a ton of data on every single strategy on here. So I mean, you got all kinds of statistics on here. You got recent performance, alpha, beta, all that kind of stuff. Composition is going to tell you what it's invested in. What are the top 10 holdings? Obviously, you can run performance over here. But if you go back to overview, I'm going to tell you guys a couple of things, a little, some sticking points that are being worked on. But you can click on all the fees right here. Now, let me tell you one of the examples. If I just expand this fee schedule, it's going to show, now this is our updated fee schedule. Um, Transamerica can't give me a good answer for this. They admit it's a problem, but they can't control it. This isn't always accurate, okay? So our default fee as a rep, just like Goldman, is 1.1. Um, but there's a lot more transparency on here. So this firm fee is accurate. This is exactly what TFA is charging for their side of the platform. Program fee is going to be a combination of Fidelity's fee plus whatever strategy you're invested in. Now, this fee isn't always going to be accurate. If anything, it will be high. The proposal you'll run, which will show you, is going to always be accurate. It's a programming issue on Fidelity's end that they admit is there, but I think the fix is a pretty big project, is essentially what has been communicated to me. But essentially, if it's inaccurate, it's usually by like 10 basis points. But just to give you guys a ballpark idea. So program fee, in fact, you can see it's 58 basis points right here. I think if I go to statistics, one of these charts is going to show me the actual fee as well. So model expense ratio so this says 14 basis points. So it's telling me right there that something's goofy with that fee. So we'll get into it, but this isn't a strategy I'm going to focus on. But if I go back here, this can give you like a snapshot, but I wouldn't get too lost into this. So let me go back to what we were running here. Okay. So this is all the SMAs. Okay. So if you want to just scan through and look at them all, I'm going to show you how to sort by any factor you want in one sec. But now if I go down here and look at fund strategist, think of fund strategist as an asset allocation portfolio. So the fund strategists are designed to be total portfolio. So you could, if you wanted to, and we're gonna have some people in our firm do this, if you want to check one box and just set an account, you could just pick any of these strategists and you'd have a fully diversified portfolio. Outside of a very unique circumstance, I can't imagine ever putting somebody fully in one SMA. And that would be a very high net worth, very unique circumstance. But this you could do a full portfolio. So think of fund strategist portfolios kind of like you would think of I series on Goldman Sachs. Basically just a broadly diversified portfolio. So if I just pick this BlackRock, let's pick a 80-20 allocation. So 80% stocks, 20% bonds. And I can look at composition over here and it's going to show me all of their different holdings, and what their fees are, all that kind of stuff. Okay. So I like these fund strategist portfolios a lot more because they are broadly diversified. They are generally speaking much lower in fees. Anytime you see a $10 million minimum, that's not really a $10 million minimum. That's just a programming thing because it's closed. So you can just ignore that. Some of those will eventually come off. But what you're going to see here, and I'm going to kind of get to some things that you guys can dig in a little bit deeper on your own. We really have five kind of companies that run fund strategists. And so one of the questions people have asked me, because I've used iSeries pretty heavily on Goldman Sachs, is that's been our only option on Goldman Sachs for, kind of a broad, passive, low cost asset allocation. So those portfolios are not coming over here because there's no reason to. We have Goldman Sachs. If you cycle through all this, Goldman Sachs, BlackRock, American Funds, Vanguard, and Fidelity. Okay. So, I mean, five household who's who names. I've never gotten really tied up into like the names or the marketing of that. I don't think that adds a lot of value. But for what it's worth, I think it's reassuring to clients, hey, you've heard of Goldman Sachs, you've heard of BlackRock, you've heard of American Funds. And so what I would tell you, give you guys a cheat sheet is, so if you're writing those notes down, I'm gonna give you those five again in this order: Goldman Sachs, BlackRock, American Funds, and then Vanguard and Fidelity. I'd encourage all of you to spend some time on what I'm going to show you next on your own, which is running different reports and comparisons. But essentially, how you could break these into two categories, okay? So Goldman Sachs, BlackRock, and American funds are going to be kind of more actively managed. So for instance, if I choose Goldman Sachs is a good example. If I choose their 90% stock model and I go to composition, they have a lot of their own strategies within this. And so each of these strategies on its own is actively managed, and then every quarter or whatever their schedule is, they're going to potentially swap out holdings depending on what their research shows to meet kind of this overall goal. In other words, they have some flexibility. This is the asset allocation as of the end of Q4, but they got some latitude here where they could bump up the equity a bit, or down a bit within some tolerances. So anytime you hear active management, I always want you to hear two things. That means higher turnover and higher fee. Okay. Always going to be true. Doesn't mean there's not a place for it, but just know going in, if I choose an active over a passive strategy, my client's going to pay a little higher fee and I'm going to have a little higher turnover. Turnover just means we're buying and selling more stocks throughout the year. So if I go to, I'm going to look for a stat here. Let's see here, overview. Believe it or not, this actually isn't too bad. I'm looking at this turnover stat, 15%. So that's pretty tax efficient for a active manager. If I go to, I think BlackRock's a little higher. If I go to BlackRock, um, let's see here, 80-20 global allocation. Look at that. Average turnover 75%. So this is going to be a lot less tax efficient. So when we run a report here in a minute, and you're going to see that over longer periods of time you have, returns get pretty tight. on passive strategies, there's going to be a huge difference in long-term returns between BlackRock and Goldman and American funds. But BlackRock's going to have the highest turnover, and then Goldman Sachs is probably maybe the lowest turnover. American funds, and I don't want to get lost in the weeds on all this today, but American funds has that name recognition, good performance, but they're going to have a higher fee, okay? And that gets to some marketing arrangement. American funds essentially has an excess fee that they charge custodians to utilize their funds. And so your client's going to pay an extra of maybe 10 or 15 basis points to be in American funds compared to a BlackRock or a Goldman. So before I've been going for a bit here. Any questions on what we've covered so far?
Tyson, is there a way to delineate between active and just passive managers on that strategist list? Is
Yeah,
there
you kind of have to just know that, and then the giveaway is going to be this turnover. Okay, so if I just covered the three that are active, that leads me to Vanguard and Fidelity are going to be your passive strategies, lower turnover. So if I now let me go back to just to show you, I'm going to choose a Fidelity strategy, Fidelity Index Focus. So this one's 85%. I mean, look, there's literally like nothing for turnover. Like it just doesn't, it rebalances, but it doesn't turn over. Okay. And if you look at, I think composition is going to show you. So this strategy is literally, I mean, half of it's the S&P 500 index. And then I mean, you've got clean, simple holdings. So I love stuff like this for portfolio construction because it gives you broad index exposure. Your cost is 3 basis points. So there's no strategist cost. Fidelity's not charging you one penny for cost. They're making their money on, believe it or not, they're making their money on this 3 basis points. Now they're also on the they have some platform stuff and all that, but I mean, we're just talking about firms with such massive scale that a single basis point is worth, who knows, tens of millions of dollars a quarter or something. And so our clients are the benefactors of that. And so the longer I've been in this business, the more I realize that if I can get broad index exposure for clients and allocate them properly and keep fees as low as possible, I'm going to do far better over time than trying to pick the hot mutual fund or reallocate this or let's chase that or this story, this tactical manager story. I could give you 30 minutes on that. My team knows this, but I think a lot of that's total BS. The amount of active managers that actually outperform over a long period of time net of fees is it's a list so small. I mean, you could fit them in probably my little home office right here. Like it's just it's a sucker's game. And so I think FMAX gives you the ability to do some of that if you want to have a little bit of diversification, but the core should be kind of long-term passive stuff. So I'm probably going to gravitate more towards Fidelity versus Vanguard. And just to give you guys the Cliff Notes version, one of those reasons is if I look at this domestic equity right here. Essentially, Fidelity is going to be a little more tilted towards US. Vanguard's going to have a little higher international allocation. And I'm just a big US investor. I just think we're just in a long-term theme. The US is beat international for the last 15 years in a row, believe it or not. Now, year to date, international is doing better than US. We'll see how the year shakes out. But even if the international crushed the US in one year, I don't think that long-term trend is going to change. And so that's just my personal belief as an investor, as an advisor. So I'm going to personally use a lot of these Fidelity funds as I build models. But I think what you guys can get to is get in here and spend a lot of time on doing some research. And so that brings us to the last category I want to show you, and then I'm going to show you how to do some research. So if you click on this UMA platform,
Hey,
this is the
Tyson.
last piece that they're going to be making an update here in, let's call it 6 to 8 weeks.
Tyson.
So yeah.
Quick question on the minimum you mentioned. So is it going to be a per account minimum, or will it be an aggregate, sort of how Goldman has done it?
It's a little bit both, and that will be, I'll get into that more. You'll see that in the proposals. It'll be a cleaner way of showing you that. Um, so stay tuned. This UMA platform So this is the next step they're working on. So right now there's like 16 passively managed mutual funds on here. And so I love this basket right here because I can get direct, super low cost exposure to any kind of, part of the market I want to be. So if I want to overweight a portfolio towards growth or towards, S&P 500, or I want to get a little emerging markets in there, I can do it. Okay. So let's zoom out for a second. The way this platform is right now is the way it's going to be for the vast majority of reps for as far as the eye can see, which is they're going to give you as the investment advisor rep a decent amount of latitude on how you build your models, how you allocate clients, all that kind of stuff. As long as you have a proposal that a risk tolerance questionnaire has been answered, which is part of that, which I'll show you, and it matches that, you're in the driver's seat here. So they're gonna let you do up to 20% of any account that you want in any combination of these funds you want. You could put 20% in one of them. So you got the Calamos funds they've added. And there's still a few that they're porting over that people are requesting from Goldman that aren't on here. So if they're not on here, they will be in the update. Dorsey Wright comes to mind that some people want to use. But the reality is you can do 20% into SMAs or FSPs, and then or 80% and 20% in these funds. What they're launching in 6 to 8 weeks here is they're gonna launch I think they're gonna call it an enhanced. Oh, I forget what they call it now. It's like an enhanced something. I don't know. But essentially, for certain advisors, they're going to beta test it with me and a couple guys. They're going to combination add. This list is going to get much longer. And by the way, that might be for everybody. This list. I mean, they're saying something like 100 or 200 more funds. But the second thing is they're going to allow you to go up to 40% in this, so give you even more latitude as an advisor. And so time will tell on who gets in that enhanced and who doesn't, and what are the requirements. Is it a licensing thing? Is it a years of experience thing? There's a lot to that. But essentially, just the fact that we have a BD guys is absolutely taking the training wheels off as an advisor is a day I never thought would come, candidly, and it's really refreshing knowing what they're willing to do behind the scenes. So that said, let's go into how you can sort through all this, and let's just say, well, how do I know which of these is good or bad or whatever? Well, so now if we go over here, back up here to the top, I've got all these kind of expanded now and you go over to this little tab called Column Manager, and you click that. So now you can sort and click of a button all of these strategies by, I mean, my God, I don't even know what half this stuff means, man. Like Sortino ratios. Ryan Wagner, could you cover Sortino ratio for the group here for the next minute? That'd be great. Um, so you can sort through all of this stuff, okay? But let me guys, like something I look at just kind of easy is you go down here to total return. And let's just say I just want to see, okay, what's the performance look like? So I can just click like, I want to look at the last 5 years. I'm just going to click the plus sign. I want to look at the last 3 years and 1 year. 10 year, I don't do a lot of 10 years because you end up just missing a lot of strategies that just haven't been around for 10 years. But I think 135 really paints a picture. So if I click apply, so you instantly, you guys, I mean, look at this data. Like instantly, the experience here compared to Goldman Sachs and trying to run strategy by strategy. I mean, this is what you're going to start discovering platform versus siloed solution. It's just, we're in a different universe here. So now, let's say I want to sort it. Let's say I really want to look at 5 year returns. I'm going to come up here. I'm going to click the little arrow. It's kind of annoying. It makes you re-expand all this stuff. And for some reason, no matter how many times I do it, it starts with like lowest return first. I don't know if it's like a conservative thing or what. But if I click the arrow again and come here and expand it again, now I'm sorted by highest return in the last 5 years. So this is the dominant column. And so you're going to see that, this might have the highest return in 5 years, but somebody else down here might have a higher return in 3 years. And so you can customize that how you want. So now if I want to sort this, let me just I want to make a point to you guys that'll maybe tie in a lot of what we've covered today on just markets in general. So there's 79 separately managed accounts on here, and most of them have at least a 50,000, if not higher minimum, okay? And higher fees. We're talking 30 to maybe 60 basis points per strategy, depending on what their fee is to manage this money. So, um, if you look at, let's look at the top performing. I mean, top 5-year return through quarter, end of last year. You got two that have just barely crossed over 20%, a couple in the 19s, a couple in the 18s. So what do you think the odds, if we went back 5 years ago and we had this whole platform and we're running with it, what do you guys think the odds are that you would have chosen out of 79, one of them that landed in the top 3 to 5? I mean, we could argue, let's say low. Now, to be fair, it's not top 3 to 5 out of 79 because some of these are like, if we go all the way down here, I mean, I wouldn't have picked a dividend or a bond strategy and expected that to beat a growth strategy over a 5-year period. But you guys get the drift, right? Of all these growth strategies. But, if I look at this, let's look at this Fiera large cap strategy. Average turnover 36%. If we look at composition, looking for the fee here. And this is what I mean by I'm a little clunky on this. I thought it showed, well, I can do it down here, but I'm not sure how accurate it's going to be. It's saying a 62 basis point, which again, until I put this in a proposal, maybe it's 52, maybe it's 62, but let's just call it 62 basis point fee. Okay. So now let me go back and let's go all the way down here. So then if you expand your fund strategist, this is actually a great commentary on markets. So your 100% all equity portfolios are up about 11 to 12. And that doesn't mean they've underperformed. That just means the last 5 years has been an extraordinary period of growth for US growth. I mean, that's just been the sector that's like where all the mega cap tech and all that's been taking place. So that's not always going to be the case. This is including international and emerging markets and all of that. But if you loaded in I series, it would be right in this mix here. Obviously, the full equity portfolios are at the top of the list. As you start getting into the, moderate growth, 80%, 75%, you're at 8, 9%. This is pretty typical long-term market performance. Okay. But let me show you one last thing. If you come down here to this UMA platform and expand on mutual fund, so your top funds in here are the Fidelity Large Cap Growth Index. I mean, this thing has a cost of like, I don't know, 3 or 4 basis points without bouncing around constantly. S&P 500 is like a 1 basis point fee. Now the NASDAQ actually has like a 20 or 25 basis point fee because you got to pay for the NASDAQ name in there. But my point is, you guys, this is why I love some of these strategies in here. Ultra low turnover, ultra low cost. Most of your clients kind of want to know, especially your growth clients, how are they doing compared to the S&P 500 anyway? So why not just put them in the S&P 500 if I'm not trying to beat it? And so that's why I like, and you're going to see when I build proposals, I like using the S&P and I like using this large cap growth index as usually 10% holdings where I can overweight or underweight. And why when they do this enhanced offering, I can do a little bit more in those and really, kind of tilt a portfolio the way I want to. But essentially, that's why I'm not going to probably use a whole lot of SMAs. There's going to be a couple of unique cases where you might want to use an SMA, which we won't get into today, but I will touch on that before we're done with all of FMAX. But in terms of just building out models and managing client money for the broad long-term growth, I think using, asset allocation up here, maybe one or two of these strategies, and then you blend in one or two or maybe three of these funds, and you put those together, you've got a really robust account. So, are you guys with me so far on how to kind of do the sort, do the filter, kind of run performance? And I mean, you're gonna have to get in and kind of fumble around yourself a little bit, but any broad questions here?
Yeah, Tyson, this is Arthur Rich. I'm kind of confused by the two systems we have. We have the Goldman Sachs and we have the list of companies that we do business with, and then we have this. They're two separate reporting systems. So in other
Yeah.
words, you're going to get your client's going to get a statement from this and a statement from Goldman Sachs. It's not together. And so why would you, if they have similar investments here as in Goldman Sachs, why wouldn't you just keep the Goldman Sachs and not bother with this?
It's actually a great question. There's a couple of answers for you. Number one, I will not have any clients that have both Goldman Sachs and Fidelity. All right, because to your point, there's just there's no case to be made for why that makes sense. So I probably will have some clients on Goldman Sachs for, I mean, many, many years to come because of either, some clients are just hard to get a hold of, some are incredibly low tech, and it's just going to be too painful to try to move them when we finally got them on Goldman. A whole bunch of reasons, right? So as I said early in this, there's nothing wrong with Goldman Sachs. Apples to apples, if you compare the two side by side, if you have fresh money to put to work, you're going to see that the Goldman Sachs platform comes in at 1.6%. You come in at 1.4% here, all else being equal. And so, for a new account, I just, as a general statement, I think your client is better off here because you have more portfolio construction tools, you have a lower price point, you have a lot more versatility as an advisor. When we start getting into some practice management stuff, which is probably going to get into next week, you'll see where this is going to completely change your life as an advisor in terms of how you manage a book of business long term. And that's going to mean a lot as you have, I don't know your business, Arthur, but as you start having 100 plus clients with advisory accounts, that's a huge deal. But to give you a snapshot to answer your question, what we now have that's already live, when you open up an account here, the if you read the fine print, it's a completely different account setup than Goldman Sachs. Goldman Sachs is a non-discretionary account. This is a limited discretion account. What that means is your client is signing a document that gives you as the advisor permission to rebalance and trade on their account without their express permission. So you no longer, in Fidelity, are going to need to call your client every time you want to make a reallocation. Now you will when you need to move money or whatever. I mean, it's limited discretion. It's not full discretion, right? And we're never going to go to full discretion. In fact, I wouldn't even be in favor of that. But limited discretion means, to give you guys just so you can kind of see where we're going, we get to the end of the book here, you're going to have the ability as a rep to build models that you want to build. Okay. And so I'm going to show you guys here, whether we get to it today or we get into it next week, which we'll see on timing here. Oh, yeah, we're at 12:25. It'll be next week. But you can build models. And then when you onboard a new client, you can just assign them to your models. This is what a lot of top advisors are doing. And this is scale. I mean, I talk about scale a lot in business. And if you can scale your time and have pre-built models and you're not building a fresh model every time you create an account. So let's just say you have your, Arthur, you have your growth model that you like based on your research, your comfort level, whatever. And it's got 4 or 5 different strategies in it. And then let's say you have 50 clients subscribe to that model. And then let's say a year and a half from now, one of those funds in there is just lagging or you want to replace it for whatever reason. You're like, you know what, I want to get rid of ABC and I want to swap it with XYZ. Well, instead of calling all 50 clients and taking a period of 5 months to work your way through all that, by the time you get all you guys, this is the world we've lived in, right? Todd, you understand. You go in there, you make a change to your model, you click a button, and it automatically reallocates everybody you have subscribed to that model into that new allocation, and you're done. I mean, so if you want to talk about scaling and building out a team and still managing a sizable, you guys, I have a sizable client base. I mean, I don't know, 3 weeks ago, I had about 90 million under management. Maybe it's 85 today or something. Who knows? The point is, like, there's a lot of relationships. There's a lot of service work that comes in. There's a lot of stuff going on there. For me to go to 90 million to 200 million, which I inevitably will, I can't, I got to have scale, right? I got to be able to do things more efficiently. And so once you get your arms around this platform, and by the way, and this is probably a good stopping point today. I've had the privilege, and it's a privilege to be on the very inside of a lot of stuff and get to know the people that are behind this platform at the highest levels. You know, the head of advisory. I mean, we spent a bunch of time together in Hawaii, countless phone calls over the last year. I know who runs our compliance at a global level. I know, you know, the systems and the technology people and all this stuff. I mean, it's like we have the right people with tremendous experience, all the way up to Michelle Berry, our president, Mike Brodeur ahead of her, that you know has deep broker dealer experience all over the industry. And so the right people, you know, in combination with an incredibly robust platform, and you have to keep in mind, for a firm our size, we are a tiny firm. Okay, if you measure us on AUM, we're tiny. But we're attached to this entity called Transamerica, which around the world is a dominant player in the world of finance. And so even though, you know, us saying, hey, we got 2 billion under management to Fidelity, I mean, that's a rounding error for Fidelity. But the global relationship between Fidelity and Transamerica, when you think about pensions, 401k, Transamerica Retirement Services, we're talking about a monster relationship. It's allowed us to leverage all of that and negotiate terms with Fidelity that virtually nobody else has. You will not see other FMAX, you know, users, of which you're going to start recognizing people that are using FMAX once you start getting into this, when you see other statements. But they're not going to have the UMA minimums we have. They're not going to have the customization. Definitely not going to have this enhanced stuff. And you guys, that's one of the reasons why I love our platform is we are a small boutique broker dealer. Guys, I could call Michelle Berry in 10 minutes, and if I didn't get her, she'd call me back, you know, after lunch. Like, how many people can call? You're sitting at LPL, you're sitting at Raymond James. You can't call the president and be like, hey, can you get this done? Or what about that? Or not that I don't abuse that, but you guys, we have a boutique company that has the resources of a global powerhouse. It's incredible. And it's taken some time to get here. And that's one of the reasons it's taken us so long to get here is because those negotiations are delicate dances. They take some time. You know, they just do. But we're here now. And so we're at a great stopping point. What I would recommend you guys all do is get in and start getting to where I've gotten and play around with these buttons and start sorting on performance and look at some fact sheets and start figuring out. I'll tell you, you know, I personally like Fidelity a lot. You know, compared to Vanguard, because Fidelity of those five is heaviest allocation towards US, lowest fee, lowest turnover. As we get into models and proposals next time, I'll probably give you an idea of where I'm going to head with this. Is I'm going to probably create two lists. I'm going to create like a growth, moderate. You know, I'll have like five or so kind of allocation buckets, but I'm going to do a qualified sleeve and a non-qualified sleeve. In other words, I want to have some diversification in my business and have clients have some diversification. So I might have like a growth qualified strategy that includes maybe the Goldman Sachs strategies that are a little bit more actively traded that might add some value because turnover doesn't matter. And then I might have a non-qualified version that just uses Fidelity where I'm keeping turnover really, but I can just click a box. And if I'm onboarding a client, okay, let's send the IRA to the qualified and the, you know, trust account to the non-qualified. And I mean, I'm just sending stuff. All that stuff's pre-built. And so it's an investment on, this is an investment on the front end of getting your arms around it. And if you're part-time here or you're a new 65 rep, I mean, don't even I mean, play around with this on your free time, but don't let this intimidate or overwhelm you. You don't need to become an expert on this for a long time, you know, when you're kind of in a training role, and we have some of you on there. But the more you kind of get your teeth in this, the more you're going to understand the value of it. And so my vision is I'm not gonna, maybe this is will be the final thing I say, Arthur. I'm not gonna like wholesale call all my clients and start moving them to Fidelity. As I do annual reviews, I'm going to just start as I do new accounts. I'm going to start doing more Fidelity here. I'm just going to start. And I'm going to have a couple years here where I'm just going to have more and more on Fidelity and still a bunch on Goldman. And that's just going to be my life. But I'll never have clients with the same. We're either going to move them to Fidelity or start them on Fidelity or keep them on Goldman. We're just not going to do a little bit here, a little bit there. So that'll address one of your issues. And by the way, the other point I make to you is everything ultimately feeds into e-money. And so you have that at your fingertips as well. And so you know, it's going to be a process, and I'm just going to embrace that me building my business is just I'm just constantly evolving. I'm constantly chipping away at it. It's never perfect. It's never done. You know, I read a great quote last week. I'm gonna try to do it from memory, but basically it says your business will always have one of three problems. You're either overstaffed because you're not growing, you're appropriately staffed because you're plateaued, or you're understaffed because you are growing. All three are problems. Welcome to being an entrepreneur. And it's like the conditions are just never going to be perfect. I'm never going to have every wheel greased and everything running and everything flying in formation. And just when I think I got all my arms around it, the market's going to go down. And yeah, I just embrace that it's going to be a little messy, but we are continuing to head in the right direction and climbing the right mountain. And I have a lot of confidence about that. So I've done almost all the talking here. Anybody have any questions on what we've covered so far as we're kind of winding down here today?
I think it's been a much better overview than anything I've seen from the company. So
Yeah,
excellent work on that, Tyson.
Cool.
I actually understand it. Well, I didn't understand it before. Now I get it. It makes a lot of
Sure.
sense.
Maybe the company will pay me for that, huh?
I just want to ditto that.
I think it's working out for you somehow.
Yeah. We're doing all right on that advisory bonus pool.
Yeah.
Yeah, Tyson, I've been on, I don't know, countless calls with these guys, and I just like Todd, I'm clearer now than I was before. That's
Great.
so
You know, listen, home office people just don't speak field. It's a different language. It just is. And you know, they don't understand. And I'm not even putting them down. They just most people in a home office have never had to sit with a client and talk them off the ledge of panic selling, or they've never had to defend poor performance of an investment. They've never had to deal with, you know, the competition element of it. They've never had to explain their fees and justify their existence. Like they just, you know, now there's a lot of things that they do, and frankly, I wouldn't dream of trading places with them, but the idea is like, you know, I just think when field leaders are speaking, and I'm certainly not the only one, I just think I kind of know where the pain points are, and that's why I do have a lot of confidence because they're listening, guys. Our home office, I'm telling you right now, I'm not gonna take you into 10 conversations I had in Hawaii last week or 2 weeks ago. I mean, they are listening. They want to get this right. They just do. I mean, it's just a big desire. We have the right people on the bus, and I just have a ton of confidence in it. And we've hired people. There's this new lady called Diane Watson is her name. I barely met her, kind of at a meal. But she's like our new director of training. I'm like, what does that even do? We've never had that role before. But one of her big roles is building out video on demand stuff and listening to the likes of me and others, and really training our reps, right? I mean, what a concept. We're actually gonna teach people as a firm how to use our tools, how to work with clients, how to do things. And she comes from a ton of industry experience. And so you guys, our firm will be unrecognizable in 2 years. The question, I'll leave you with this. The question is, at what level do you want to play at? I mean, I was having a conversation with somebody yesterday, and we were talking about timing and you know, frustrations and just never free time. How do I fit this in? The guy's part-time in our business. And I said, you know, I'm still waiting for the right time to have kids. Like I'm still waiting for the right, all the plans to be in alignment. And my oldest is now 16 and a half years old. So I say that a little tongue in cheek. You know, there's just never going to be the right time to just start doing this or work this into your business or carve a little bit extra time. But I'll tell you right now, make hay while the sun's shining, and the sun is shining right now. I mean, I'm personally, I'm about to make a massive cash investment into my brokerage accounts here. I'm trying to get a couple things opened up for my retirement plan because I mean, stocks are on sale right now. And this is when you grow your business, you know, and all the work I've done, you know, I mean, guys, I've doubled my cash flow in the last 3 years, you know, and I think I can double it again in the next 5 to 6 years. Like, I mean, this is the time to launch. And so get in here, learn some stuff, play around with it. That's how you're going to figure this stuff out. Start looking at the fact sheet, start educating yourself, and you'll start figuring out, okay, turnover and performance and fee. You're going to start figuring all that out. And then next week, we're going to get into how do you take, okay, now that you know what kind of 4 or 5 strategies you want to work with, I'll just show you what I do. How do you build a model? How do you put that into a proposal? And then I mean that'll be a full hour right there, and then we'll continue with opening an account and those kind of things. So I appreciate you guys hopping on. I'm glad we added some value today, and keep it rocking and rolling. We'll talk to you guys next week.
Thank you.
Thank you.